Question number 5. How do I avoid paying high taxes by using our investment properties? So if you watched any of my previous episodes, I may have addressed this question, but this may be the first time that you're seeing me or hearing one of these questions or watching one of these episodes. So I am going to do my best to answer this question as thoroughly as possible. Number 1, the only way an investment property can help you save money on taxes is through one or two ways. Maybe three ways. The first way is you have some passive income coming from somewhere. And when I say passive income, I mean it is true passive income. True passive income, meaning not passive because you deem it passive, but passive because the IRS says it's passive. So there's a difference with passive in knowing what type of passive income you have and how does it apply to your taxable liability. And if you don't know if your passive income streams are passive in the eyes of the IRS, then you need to figure that out. And maybe we should have a separate training on that one day. But you got to have passive income. If you have passive income, that passive income can offset passive losses that we can create on your tax return to help reduce your taxable liability. Real estate is always passive unless you can make it active. Always. If you cannot make it active, that is a passive investment. It's going to create either passive income or passive losses. If it creates passive losses and you do not have any other way to offset those losses on your tax return, those losses are going to carry forward on your tax return until you are able to claim them. There are many people who purchase rental properties. They're purchasing one a year or two a year because they're just trying to build their portfolio of properties. And they are not receiving the tax advantages of doing so because it is still passive to them. They have not found a way to make those rental properties active losses to offset other income. They just haven't. So I have one client who has $287,000 in passive losses rolling forward on her tax return because she's unable to claim them. And she didn't know that prior to coming to us. She was completely shocked because in her mind, we've been telling the tax preparer or the CPA every single month or every single year about these properties. These properties have been on my tax return. I see the losses, but she just never understood how to read the return to understand that those losses were not offsetting her income. Now she knows, and now we're building a plan to utilize those losses. But you have to know that you have carry forwards on your tax return that you're unable to claim. So that's number 1. Number 2, if you are a real estate professional, and again, just like with the passive income, I'm not speaking of just a regular broker or agent or someone who works in construction. I'm talking about someone who meets the definition of a real estate professional in the eyes of the IRS. Now, in the eyes of the IRS, a real estate professional is a person who works in the real estate industry directly, not indirectly, directly in the real estate industry. You spend more time working on real estate than you do anything else. You are keeping and maintaining a contemporaneous time log of your hours and how you're spending your time. And you spend more than 750 hours a year in that activity. Okay? If you can meet that qualification, then maybe you are a true real estate professional in the eyes of the IRS. But what does that really mean? That means that if they have properties that they own more than 5% of or greater, and they are acquiring, they're developing, redeveloping, constructing, renovating, managing, leasing, brokering real estate, and they're getting their hours that way, then they probably meet that definition of being a real estate professional. And if you meet that definition of being a real estate professional, that means that any losses that we can create, yes, we can create losses on real estate. These losses are no longer passive. These losses become active. And those losses can offset any other type of income on your tax return. So it can offset W-2 income. It can also offset portfolio income. It can offset tax-exempt income, royalty income, ordinary income, earned income. It can offset all types of income on your tax return. It is one of the best tax advantages in the tax code. But you have to be able to meet that definition, and that definition is actually very stringent. You also have to own rental properties. I get this a lot. I'm a real estate agent. I spend 2,000 hours a year working in this business. How do I take advantage of being a real estate professional in the eyes of the IRS? That's all great, well, fine, and dandy. But if you don't actually own any properties yourself, where you are an actual investor, it doesn't matter. That particular provision in the tax code does not apply to you. We can't create losses on something you don't earn, on something you don't own. We can't. You got to own the property, and you have to own more than 5% of it. So, for all of the brokers, agents, people who say, I'm full-time in real estate, and I haven't figured out how to save money on my taxes yet, that's your problem. You may not own properties, or you may own properties, but you're not creating the losses that you can on those properties to offset other income. Number 3, if your modified adjusted gross income, not your adjusted gross income, but your modified adjusted gross income. If your modified adjusted gross income is less than $100,000 a year, you're able to make $25,000 in losses, active losses, to offset other income. Now, if your modified adjusted gross income is between $100,000 and $150,000, then that $25,000 loss that you can create to offset other income on your tax return is going to be minimized or reduced the closer that you get to $150,000. So at $150,000, it completely phases out. There's no other losses you can take without being passive income, passive losses, or a real estate professional.